International finance. It refers to the study of financial transactions between countries, including foreign investments, trade, and currency exchange. It examines how international financial markets, institutions, and policies affect global economic activity and how different nations interact with each other in the realm of finance. Study of international finance. International finance refers to the study of financial interactions and transactions between different countries and the global economy. It is a vast and complex field that involves analyzing financial flows, investments, and the effects of economic policies on a global scale. International finance is vital for businesses, governments, and individuals to navigate the global financial system and manage risks. The study of international finance involves several areas of focus, including foreign exchange rates, international trade, financial markets, and international investments. One key aspect is foreign exchange rates, which is the value of one country's currency in relation to another country's currency. Foreign exchange rates play a significant role in international trade and finance, affecting the prices of goods and services, investment decisions, and financial flows between countries. Another important aspect of international finance is international trade, which involves the exchange of goods and services across borders. International trade is facilitated by financial instruments such as letters of credit and trade finance, which enable buyers and sellers to conduct transactions in different currencies and manage the risks associated with international trade. Financial markets also play a significant role in international finance, with investors seeking opportunities to invest in different countries and regions. Financial markets include stock markets, bond markets, and currency markets, and they are interconnected across the globe. Understanding how financial markets operate and how they impact the global economy is essential for businesses and investors looking to expand their operations internationally. International investments are another critical aspect of international finance, with investors seeking to diversify their portfolios by investing in assets and securities from different countries. International investments can include stocks, bonds, real estate, and other assets, and they involve managing risks associated with currency fluctuations, political instability, and other factors. The study of international finance involves analyzing economic policies and regulations that affect the global financial system. These policies can include monetary policies, such as interest rate adjustments, and fiscal policies, such as government spending and taxation. Understanding how these policies impact the global economy and financial markets is essential for businesses and investors seeking to navigate the global financial system. In conclusion, international finance is a critical field of study that involves analyzing financial interactions and transactions between different countries and the global economy. It includes several areas of focus, such as foreign exchange rates, international trade, financial markets, international investments, and economic policies. Understanding these areas and how they impact the global financial system is essential for businesses, investors, and individuals seeking to navigate the complexities of the global economy and manage risks associated with international finance. Importance. International finance management is a crucial component of the global economy, and its importance cannot be overstated. Importance of international finance management. Facilitating international trade. International finance management helps to facilitate international trade by providing the necessary financial instruments and services that enable businesses to conduct transactions across borders. This includes trade finance, foreign exchange services, and payment services. Managing foreign exchange risk. Businesses engaged in international trade are exposed to foreign exchange risk, which arises from fluctuations in exchange rates. International finance management helps businesses manage this risk through hedging strategies, such as forward contracts and currency options. Attracting foreign investment. International finance management plays a crucial role in attracting foreign investment into a country. Investors seek a stable and predictable financial environment, and a country that manages its international finances effectively is more likely to attract foreign investment. Access to capital markets. A country that manages its international finances well is more likely to have access to international capital markets, which can provide an important source of funding for businesses and governments. Economic growth. Effective international finance management is critical for economic growth. It enables countries to attract foreign investment, manage their external debt, and facilitate international trade, which can contribute to economic development. Managing external debt. International finance management is important for managing external debt, which is the amount of money that a country owes to foreign lenders. Effective management of external debt is critical for maintaining a stable financial environment and avoiding financial crises. Controlling inflation. International finance management is important for controlling inflation, which is the rate at which prices of goods and services increase over time. Effective management of international finances can help to stabilize currency values and prevent inflation from spiraling out of control. Managing financial crises. Effective international finance management is important for managing financial crises. Countries that manage their international finances effectively are better equipped to respond to financial crises, such as currency devaluations or debt defaults. Fostering international cooperation. International finance management can foster international cooperation and coordination. This is important for addressing global economic challenges, such as financial crises or economic inequality. Promoting sustainable development. Effective international finance management can contribute to sustainable development by facilitating international trade, attracting foreign investment, and promoting economic growth. This can help to create jobs, reduce poverty, and improve the standard of living for people around the world. In conclusion, international finance management is a crucial component of the global economy. It facilitates international trade, manages foreign exchange risk, attracts foreign investment, and contributes to economic growth. Effective management of international finances is important for managing external debt, controlling inflation, and responding to financial crises. It can foster international cooperation and promote sustainable development. Nature of international finance management. International finance management is a complex and dynamic field that involves managing financial interactions and transactions between different countries in the global economy. Here are 10 nature of international finance management. Cross-cultural understanding. International finance management requires a deep understanding of different cultures, as financial practices and customs can vary widely between countries. Managers must be able to communicate effectively with individuals from different backgrounds and be sensitive to cultural differences. Global perspective. International finance management requires a global perspective, as financial markets, policies, and regulations are interconnected across the globe. Managers must be able to analyze economic and financial trends on a global scale and understand how they impact the financial system. Multinational operations. International finance management often involves managing multinational operations, which can be complex and require expertise in various areas such as accounting, tax, and legal regulations. Managers must be able to navigate different regulatory environments and manage operations in different countries. Foreign exchange risk. International finance management involves managing foreign exchange risk, which arises from fluctuations in exchange rates. Managers must be able to develop strategies to manage this risk effectively, such as hedging or currency diversification. Global capital markets. International finance management involves managing financial instruments such as stocks, bonds, and currencies in the global capital markets. Managers must be able to analyze and evaluate different investment opportunities and manage risks associated with international investments. Economic policies. International finance management involves analyzing and evaluating economic policies such as monetary policies and fiscal policies that impact the global economy. Managers must be able to understand how these policies impact financial markets and manage risks associated with changes in economic policies. Political risks. International finance management involves managing political risks associated with doing business in different countries. Managers must be able to evaluate political risks such as changes in government policies, political instability, and corruption and develop strategies to manage these risks. Financial reporting. International finance management involves managing financial reporting, which can be complex due to the different accounting standards and reporting requirements in different countries. Managers must be able to develop and implement reporting systems that comply with different regulatory requirements. Technology. International finance management involves managing technological advances and digitalization that are transforming the financial sector. Managers must be able to adopt new technologies and use them effectively to manage financial operations. Sustainable development. International finance management involves promoting sustainable development by investing in projects that promote economic growth while also protecting the environment and promoting social responsibility. Managers must be able to evaluate the social and environmental impact of investments and develop strategies to promote sustainable development. In conclusion, international finance management is a complex and dynamic field that requires cross-cultural understanding, a global perspective, expertise in multinational operations, and the ability to manage risks associated with foreign exchange, economic policies, and political instability. It also involves managing financial reporting, adopting new technologies, and promoting sustainable development. Effective international finance management is essential for businesses and governments to navigate the complexities of the global financial system and manage risks associated with international finance. Scope of international finance management. International finance management has a wide scope and covers various areas that are essential to the global economy. Here are 10 scopes of international finance management. Corporate finance. International finance management involves managing the financial operations of multinational corporations, such as budgeting, forecasting, and risk management. This includes managing foreign exchange risk, access to capital markets, and financing for overseas operations. Investment banking. International finance management includes investment banking services such as underwriting, mergers and acquisitions, and securities trading. Investment bankers help businesses and governments raise capital in the global capital markets. Foreign exchange. International finance management involves managing foreign exchange transactions and managing exposure to currency risk. This includes managing foreign exchange reserves, currency hedging, and managing the impact of exchange rate fluctuations. Trade finance. International finance management includes trade finance services such as letters of credit, factoring, and export credit. Trade finance enables businesses to conduct international trade and manage risks associated with cross-border transactions. International monetary policy. International finance management involves managing international monetary policies such as interest rates, exchange rates, and inflation. This includes analyzing global economic trends, evaluating risks, and developing policies to promote economic stability. International capital markets. International finance management includes managing international capital markets, such as equity and debt markets. This involves analyzing market trends, evaluating risks, and developing investment strategies to maximize returns. Cross-border mergers and acquisitions. International finance management includes managing cross-border mergers and acquisitions, which involve complex financial transactions between businesses in different countries. This includes evaluating risks, negotiating deals, and managing the financial aspects of the transaction. Sovereign debt. International finance management includes managing sovereign debt, which is the debt owed by governments to foreign lenders. This involves managing external debt, analyzing creditworthiness, and managing the risks associated with borrowing from foreign lenders. International taxation. International finance management includes managing international taxation, which can be complex due to the different tax laws and regulations in different countries. This involves analyzing tax laws, developing tax strategies, and managing tax compliance. Sustainable development. International finance management includes managing investments that promote sustainable development, such as renewable energy projects, environmental protection, and social responsibility. This involves evaluating the social and environmental impact of investments and developing strategies to promote sustainable development. In conclusion, international finance management has a wide scope that covers various areas essential to the global economy. This includes managing corporate finance, investment banking, foreign exchange, trade finance, international monetary policy, international capital markets, cross-border mergers and acquisitions,